All right, congratulations. You've made it. You've made it to the Holy Grail, which is the IPO, the initial public offering. You're going to love this session. This is a lot of fun. So you've done it. You've done it. You're going to go public now. All this hard work is paying off. 8 years of hard work. Okay, great. So here's where you are, year 8. Before we do it, I want to cover a valuation topic in the consumer space. I want to talk about why Facebook bought Instagram. Okay, so we've talked about valuation and modeling for companies that have revenue and earnings. But what about companies that don't have earnings? When you see a company like Facebook buying a company that's not profitable, that really doesn't have any revenue like Instagram, you might say, WTF, why the face, right? So I'm going to explain why they did this acquisition and how to value companies that don't have revenue, okay? All right, so Facebook bought Instagram for $1 billion a couple of years ago, right? And people said, well, I don't understand. They don't have any revenue. They certainly paid too much. Nonsense. Instagram in 2011 had 1 million users. And then they had over 100 million users in 2012 when Facebook bought them for $1 billion. They got a steal. Facebook's market cap at the time of me making these slides, Facebook's market cap divided by the number of users of Facebook or subscribers or subs equals the value per sub that investors are paying for Facebook today. And so when Facebook bought Instagram, they had a market capitalization or value of the company of $231 billion, right? And let's assume they had, I don't know, around 1.4 billion subscribers, right? So that basically means $165 per subscriber. This is not exact, but it's close enough. So the market values Facebook at $165 per subscriber when they bought Instagram. Instagram was bought for, you can use this math, the Instagram price that Facebook paid divided by the Instagram subscribers or number of users, and that equals the value per subscriber. And so Facebook paid $1 billion for Instagram, divided by 100 million Instagram users. Recall this is back in 2012, which was only $10 per subscriber. It's a steal. It's a bargain. It's an accretive acquisition, right? So today there's over 300 million users, which is less than $5 per subscriber. And I think that 300 million users is way off. I wouldn't be surprised if it's much, much higher than that. My kids don't bother using Facebook. It's all about Instagram now. Instagram's more fun. Pictures rock, text is boring. Okay. So if Facebook was valued at $165 per subscriber when they bought Instagram, and assuming that Instagram is worth at least half the value per subscriber of Facebook, then if you take 80 million bucks times 200 million subs or so, and this is very rough, that means that Instagram today would be valued at more than $16 billion. Right, so that was a great return on investment for Mark Zuckerberg. Brilliant, actually, brilliant. And so Instagram is really worth between $16 and $32 billion today. Okay, all right, I get it, Chris, I get it. Valuation for high growth consumer tech companies is based on subscribers. Makes sense. So what did Facebook pay for WhatsApp? And by the way, WhatsApp was a company that, of course, Sequoia invested in, and Sequoia made, I think, $2 or $3 billion on selling that company to Facebook. Just amazing, amazing. All right, so if you look at the growth rate of users, it is unbelievable. And so Facebook had to buy WhatsApp because Facebook, has 1.4 billion subscribers. But most of Facebook's subscribers are in first world countries, and WhatsApp has great penetration in second world countries. And so it was a natural fit for Facebook to buy this company. Okay. Plus, Facebook Messenger sucks. We all know that. So Facebook paid $20 billion for WhatsApp, and they kind of had to do it, right? And I'm not going to study the math too much on that acquisition, other than to say that it made a lot of sense for them to do it because Facebook used the stock price, their stock and cash to buy it. And so it doesn't matter if people think that Facebook stock is overvalued. They use that form of currency plus cash to buy WhatsApp, which made a lot of sense. So take a look at this chart. So Mary Meeker who's an amazing investor and a partner at Kleiner Perkins. She and her team create this amazing report every year. And here's one of the slides from this report. And you got to read these reports. They're off the charts. They're amazing. So you could see that Facebook, the number of subscribers or the percent of people between the age of 12 and 24, right? They like visual stuff, right? Like Instagram or Snapchat or Pinterest, okay? They don't like boring text like economist stuff. That's why I always prefer reading, USA Today, versus, The Economist. I know that doesn't sound very sophisticated, but USA Today is more fun to read. Okay, so Facebook, the percent of people between 12 and 24 that are using Facebook is declining, okay? It's scary for Facebook, actually. And the percent of people between the ages of 12 and 24, which is the future, using Instagram is on the rise, okay? And if you look at this chart at the very bottom, you'll see WhatsApp. Look at that growth from nothing, right, to 11%, within 1 year. And I'm sure it's much, much higher now of people using WhatsApp between the ages of 12 and 24. So Facebook had to do this acquisition, because growth for them, remember, it's declining. Growth is still positive for Facebook, but it went public like all companies go public because growth is positive, but slowing, okay? All right, great. Okay, so Facebook paid $20 billion for WhatsApp. And WhatsApp at the time had 700 million subscribers. So they paid only $28 per subscriber, okay? So valuation methodologies really differ a lot based on what industry you're in. And I'll run through some examples. So short-term valuation drivers for different sectors is radically different from others. And so for consumer internet, we know it's subscribers. For enterprise technology, we know it's revenue. Semiconductor companies, it's earnings. Hotels, it's RevPAR. What is RevPAR? RevPAR stands for revenue per available room. That's how Wall Street or analysts value hotel companies. RevPAR, revenue per available rooms, RevPAR, right? And industrial companies, they look at commodity prices, earnings, and volume. Telecommunication companies, when you value those, you look at ARPU, which stands for average revenue per users. And then retail, you look at same-store sales, or SSS. Why? You just care about how each store is growing year over year, right? If a retail company opens too many new stores, then I get worried about, how much can they grow organically. I want to see them grow a lot per store. And a great example of this is McDonald's, which a number of years ago, they decided to, instead of closing at midnight, be open 24 hours a day. And so same-store sales growth skyrocketed, and investors loved it. And then McDonald's started selling coffee to compete with Starbucks, right, or $4. And so what happened was McDonald's, investors loved it. And so what is their next trick? What is McDonald's going to do next to increase SSS, or same-store sales growth? I have no idea. Okay, so biotech, the short-term valuation driver is FDA approval. Investing in biotechs is tough. It's usually a binary event. The stocks go up a ton or down a ton if they get FDA approval. And that's the Federal Drug Administration. I don't know much about that sector, but anyway, that's how those stocks move. Okay, so long-term drivers for every single sector is earnings and cash flow. All sectors, okay? That's all that matters in the long run, okay? Great. So additional valuation methods. So we can look at our private company's valuation. We're now in late 2019, okay? Microsoft, I don't know if I told you this, but Microsoft just offered to buy our company for $1 billion. And it was insulting. Their investment bankers approached us, and we just said no in our hypothetical example. We want to go big or go home, right? We want to put a damn dent in the universe. We want to go public now, and we're going to use Goldman Sachs to do this, right? Okay, great. So what happens is we're going to ask our venture capital firms that have invested in us, Sequoia, Kleiner Perkins, and Ameritech, 3 great firms. Again, this is hypothetical. We're going to ask them for advice. And they all recommend that we hire Goldman Sachs. Okay, so we're going to hire Goldman Sachs. And Goldman Sachs is going to bring in other banks with them, including UBS, 2/3 of which is BS. I'm just kidding. You could say the same thing, by the way, for Harvard Business School or HBS, 2/3 of BS, and you can quote me on that too. I'm kidding, sort of. Okay, so Goldman Sachs, sorry, I digress. Goldman Sachs is going to bring in other banks, right, into the syndicate. They're going to bring in UBS and Morgan Stanley, right? And the reason they're going to bring in other banks to help them is because this is going to be a large IPO. And Goldman doesn't want to just use their own balance sheet. They want to kind of use other firms as well, right? And we want that too. You know, our company wants to have multiple investment banks taking us public. Why? Because we're going to pay the investment banks based on how well they do taking us public, okay? We're going to allocate more commissions to maybe UBS or Morgan Stanley if the salespeople at those firms do a better job selling our stock, okay? Competition is always good for the consumer. Okay, and Goldman's got a great reputation, so does Morgan Stanley and UBS, okay? All right, so we just hired Goldman to do the IPO, and this is really exciting, man. This is awesome. Okay, great. So what do the employees at Goldman Sachs do for our private firm? And I used to work at Goldman years ago. It's a great firm. What do they do? So I'm going to explain the anatomy of an IPO or an initial public offering. What does it mean? Okay, so let's do it. So investment bankers are a bunch of smart finance people that work at underwriting a company. What does that mean? Well, they do all the legal work and paperwork to evaluation stuff to put together an IPO. They'll tell you what valuation you should use for the IPO, right? And they'll use actually the methodologies we just talked about. DCF, price earnings, price revenue, okay? And they'll also list all the risks investing in this IPO as well, right? And they'll put all those risks in what's called the IPO prospectus, which is basically a 100-page book that all investors get. And there's electronic versions too, of course, available now. And all risks have to be disclosed, right? And it's a lot like the 10K, except it's called the S1. And the S-1 is an IPO prospectus. It's a 100 or 200-page document that goes on sec.gov. Okay, so you can go to sec.gov right now, type in FB or Facebook sticker, and you can look at the S1 from Facebook when it went public back in 2012 and what the risks were at that time. Biggest risk was they didn't have a mobile strategy. Okay, back to our company and the anatomy of an IPO. So the investment bankers do all the paperwork, okay? And then what the investment bankers do at Goldman Sachs is they will talk to another group at Goldman Sachs called ECM, or Equity Capital Markets. And Equity Capital Markets will help them write a 20-page sales memo. They'll basically condense a lot of that information in the prospectus to 10 or 20 pages. And then the Equity Capital Markets people will then go and talk to the salespeople that work on the trading floor at Goldman Sachs, okay? And they'll tell the sales force, the salespeople that work on the trading floor at Goldman Sachs, they'll tell them how to sell the deal, right? They won't just tell them all the positive things to tell their customers. They'll tell them the negative things too. You always want to list risks. Whenever I sell a product, a service, all I have is my integrity. And that's all I take with me from one company to the next that I work at. And so within the first 5 to 15 minutes or whatever it is, I always mention risks, right? With any investment that I pitch to people, okay? All I have is my reputation, okay? And so what happens now is these salespeople at Goldman will get on the phone and they'll call their clients, like Fidelity, which is a big mutual fund, or hedge funds like Citadel. They'll call them all and they'll explain the deal. I've got this company going public now. The valuation is very attractive relative to the competition. I see 30% upside. Here are the risks though, blah, 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 whatever. So they'll do that. And then what happens is all these clients will place their orders, right? They'll call the traders that work at Goldman Sachs on the trading floor that partner up with the salespeople. And they'll say, the traders, the clients will say, this deal sounds really good. I want to buy $50 million worth with no pricing sensitivity. Or they'll say, I want to buy $10 million worth, but at the low end of the valuation range. What does that mean? Well, typically, IPOs, the way it works is there's a range that's given because you never know where it's going to price exactly. So for our company, let's say we're going to price it between 15 and 17 bucks, for example. If it's a hot deal, people will call you up and they'll say, they'll call their Goldman salespeople, like the mutual funds. Yeah, it sounds like a great deal. I want to buy $100 million worth with no pricing sensitivity, right? And what you just saw there was a client that padded his order. They gave a much bigger order than they wanted, right? Because they knew that it was a hot deal, okay? Or a deal that was going to do exceptionally well, okay? And so I remember years ago, I remember actually on the Facebook IPO, I'll never forget, a salesperson from a certain investment bank called me and said, Chris, you're going to be very happy. I fought very hard for you, and you're getting 100% of the allocation that you wanted on the Facebook deal. I hope you're happy with this. I hung up the phone and I thought, okay, I've been through this game before. There's a signal there. I was just signaled that the deal's not going well. And so anyway, it's a game. It's a game, right? Goldman's got a great reputation. They have great ethical integrity and all that stuff. So they do it the right way. Anyway, so then what happens is the company going public talks to Goldman Sachs, and the company decides who to give the shares to. Okay, Goldman will fight hard to make sure a lot of shares go to the customers of Goldman Sachs that pay the highest commissions, the ones they do the most business with. Okay, but what happens is the company will also tell Goldman who to give shares to. Okay, and the company during the roadshow process, which basically means they had tons of meetings or 100 meetings with potential investors, they'll remember which investors knew their story the best. And they'll want those investors to get shares, right? More shares than others, because those investors are not tourists. They're not tourists. They're not renting the stock. They're there for the long haul. And what the company wants is underlying shareholders that are going to be long-term shareholders and are going to buy more shares when the stock goes down. And these companies that go public, and Goldman Sachs can always track, or almost always track, which investors sell shares in an IPO quickly to profit. They never sell through the investment bank that took them public like Goldman Sachs. They sell it through other firms, okay? So it can't be tracked. But it can be tracked because every 3 months, it's SEC law that big mutual funds and hedge funds have to disclose what their long positions are. And so the companies that don't flip or sell IPOs quickly tend to get more shares than others. Okay, so that's the anatomy of an IPO. And so the traders at the end of the day at Goldman Sachs will distribute the shares to the clients. And then what Goldman Sachs does is they actually take their fee, or their 7% fee or 5% fee or whatever it is, right? And then hopefully on the first day, the stock goes up tremendously. Okay, so Goldman gets their fees and they look like heroes. And if they look like heroes and the stock goes up a lot, then other firms that want to go public will hire Goldman Sachs. Okay, and so Goldman then wires all the money, less their fees, directly to the company that went public.